Hi students, welcome back to my channel. So in the last session we completed consolidated financial statements and I hope you enjoy that video. And in this session, so I'm going to discuss and one of the important and easiest topic for CA Inter as well as for CMA Inter, nothing but for buyback. So buyback of equity share. In advanced accounting paper, frequently in every attempt we can expect one question from this chapter either in case based scenarios or in descriptive part. So you can expect at least around for 8 marks. You can expect it around for 8 marks. Okay, so without wasting the time I will move on directly to the buyback. And before that, so if you are new to my channel, so please subscribe it and watch the entire video. You are going to get more concept and more clarity about the buyback. And also I will discuss not only the concepts, and also I will try to discuss few problems which are very important from the exam point of. So don't skip the video. So please go through the entire video. If you like the video, please press the like button and share it to your friends who are going to write the exams. And also give the comments below the video how you liked it, and also mention which topic you want in the next session. And based on that, I will plan the further sessions. Okay, so I will move on to the chapter. And this handwritten notebook, so I will upload it in my Telegram channel, and the Telegram channel link will be provided in the description box. Okay, so please join that channel, and there you can contact me directly. Okay, so here coming to the buyback. So first of all, what is meant by buyback? Buyback means simply is nothing but buying back of our own equity shares by the company. Buying back of our own equity shares by the company. As per Section 67 of Companies Act 2013, reduction of the capital is restricted. Actual capital cannot be reduced as per Companies Act, but only in two cases it is allowed, and one of the exception is nothing but what doing the buyback. Doing the buyback. But so what are the conditions required to be satisfied for doing the buyback are provided under Section 68, and some conditions are mentioned in Section 69 of Companies Act 2013. Coming to the Section 68. So first one, Articles of Association approval, AOA approval is required, and a special resolution is required to be passed in the general meeting. So for authorizing the buyback. But remember, this AOA and the special resolution, these 2 points are required only when if the buyback is more than 10% of the paid up share capital and the free reserve. 10% of the paid up share capital and free reserves. Okay. So for example, if the buyback is less than 10% of the less than or equal to the 10%, then remember only board resolution is enough. And for example, here paid up share capital is 10 lakhs and free reserve is 5 lakhs. For example, total amount is 15 lakhs, and the 10% is nothing but 1 lakh 50,000. If the buyback is less than or equal to 1 lakh 50,000, then only board resolution is enough. If the buyback is more than 1,50,000, in that case, AOA approval and the special resolution in the general meeting is required to be followed. Okay. So these 2 points is required only if the buyback is more than 10% of the paid up share capital and free reserves. Otherwise, just board resolution is in the board meeting is enough. And next one, only fully paid up equity shares can be bought back. This is one of the important point here. Only fully paid up equity shares can be bought back. In case of partly paid up, what we do? First, make it them as a fully paid up. First, make it them as fully. How can we make it them as fully paid up? First, make a final call and receive the amount. First, demand the final call from the shareholder. So then we write the entry what? Share final call account debited to equity share capital account. And when we receive the amount, we write the entry bank account debited to share final call. So If the equity shares are fully paid up, then only we can do the buyback. In case of partly paid up, first demand them and receive the amount. So in such a way, we make them as a fully paid up, then only we can do the buyback. And another one is no two buybacks allowed within 12 months. So if one buyback is completed, from the completion date of the buyback, another buyback is not allowed within 12 months. Only one buyback is allowed in a 12 months period. And buyback should be completed within 12 months from the date of special resolution. If the special resolution is passed up in the general meeting, from the date of special resolution, within 12 months, we have to close it. And this is another important from the exam point of view. What are the sources we have? And remember, there are two sources for doing the buyback. And one is free reserve, and another one is proceeds from the fresh issue of equity, fresh issue of shares other than same class of share. So here, free reserves means what? Those reserves which are freely available for distribution of dividend to the shareholder. And as per section 52, if you remember, as per section 52, what it says section 52? And utilization of, so utilization of security premium. Security premium can be utilized for five purposes, if you remember, and that was provided in section 52. And one of the purposes, security premium can be utilized for buyback of equity share. Generally, only free reserves are utilized for buyback of equity share as per section 68. But as per section 52, security premium can be utilized for buyback of equity share. And section 52 is a overriding section. And that's why security premium is also treated as a part of the free reserve only for the purpose of one thing, nothing but for section 68, nothing but buyback. So remember, throughout the chapter, always remember free reserves nothing but what? General reserve, profit and loss account, revenue reserves if any, and the security premium. Security premium is generally a specific reserve, not a free reserve. For the purpose of section 68 only, it is treated as a part of free reserve. And another one, so proceeds from fresh issue of shares other than same class of shares bought back. For example, if the preference shares we issued and the proceeds we can use it for buyback of equity share. Okay, and this is the one of the important point. And a revaluation reserve and capital reserves are not treated as what? Free reserves. Okay, fine. So from the exam point of view, 2 points for a problem at problems point of view, 2 points we covered. Only fully paid up equity shares can be bought back. And what are the sources we have? Two sources. One is the free reserves, including security premium. Second one, proceeds from fresh issue of shares other than same class of equity shares bought back. And third one, third rule is if the buyback is made out of free reserve. And actually, this is provided in Section 69 of Companies Act 2013. If the buyback is made out of the free reserves, and remember, the nominal value of equity shares bought back is transferred from free reserves to the CRR. Free reserves to the CRR. So, I will explain it. So, here is the balance sheet of company. Equity share capital, preference share capital, general reserve, and other creditors. For example, say 10 lakhs and 5 lakhs and 15 lakhs, 5 lakhs we have. So total 25, 35, 35 lakhs. And 35 lakhs is what? Assets. 35 lakhs is what? Assets. And what are the options we have to do the buyback? For example, here and the 3 lakh, 2 lakh equity shares we are buying back. 2 lakh equity shares we are buying back. And the sources what we have? One is the free reserve and another one is proceeds from fresh issue of shares. Proceeds from fresh issue of shares other than same class of equity shares bought back. And if the buyback is made out of the free reserve, if the buyback is made out of the free reserve, then what happened? what here generally free reserve here is nothing but what general reserve, profit and loss account or security premium for the purpose of section 68. Generally free reserve is available in the form of what? Assets only here. Any liability is available in the form of asset. And remember, as per the Companies Act, sale of amount realized by sale of the asset cannot be distributed in a unfair manner. And any amount realized by sale of the asset should be distributed in a particular order stated as per Companies Act 2013. And like first we have to pay that amount to the outside creditor, and after that if anything available to the preference shareholder, and after that to the equity shareholder. This is the general order. And if the buyback is made by the company, then if buyback is made by the company out of the free reserve, then what happened? The any one of the asset has been sold, or cash, any surplus cash we have, that surplus cash we have will be used for payment to the equity shareholder. And it means here assets have been decreased. So for example 2 lakh, the assets have been decreased and equity share capital has been decreased. And previously, before the buyback, what is the total assets available in the company? 35 lakh. Means the total security available to the creditors is nothing but what? 35 lakh. But if the buyback is made, the total security available to the creditor in the form of the assets have been decreased. So before buyback, what is the total assets we have? 35 lakh. After buyback, it will be the 33 lakh. There is a reduction in the value of assets, and assets is nothing but which are the security to the creditor. And without paying them, we are directly paid to the equity shareholder. And that's why we have to give the intimation to the creditors that we are not using that amount to pay to the equity shareholder. Whatever the amount we are using, that will be transferred to separate account, which is in the form of equity shareholder, which will be converted into the equity shareholder in the future. That is nothing but what? CRR. That is nothing but what? CRR. CRR is nothing but what? Capital redemption reserve. Capital redemption reserve, which is created only when if the buyback is made out of free reserve. Only when if the buyback is made out of free reserve or security premium. And how much amount is transferred? The nominal value of equity shares bought back out of the free reserve. And another one, and why it is created? Why it is created? To provide security to the creditors. To provide what? Security to the creditor. And one more reason is there, and it is also mentioned as to maintain the capital as intact. Capital as intact. And if here, if you buy back the equity share, then previously before that, equity share capital is 10 lakh and the preference share capital is 5 lakhs and total capital is 15 lakhs. If the equity shares bought back, then 2 lakh has been decreased. Then equity share become 8 lakh and this is 1 5 lakh. Total amount is 13 lakh. And there is a reduction of capital. There is a reduction of capital. So to refill it, and one more reserve has been created which will be converted into the equity shares only in the future. That is nothing but what? CRR. Then the total specific capital, fixed capital will become what? 15 lakh again. 15 lakh again. Here CRR is a specific reserve and CRR is used only for issue of fully paid up equity share, and simply nothing but CRR will be the future equity share capital. So it is also forming part of what? Equity share capital. So to refill it, so because of buying back of the equity share, the capital was changed. So if it is made out of the free reserve, so 10 lakh, previously we have 10 lakh equity share, 2 lakh we bought back, and total how much amount is there? 8 lakh. And preference share capital is not affected. Total 13 lakh is there. Before that 15 lakh we have. So 2 lakh has been decreased. So the reduction of the capital will remains in the form of what CRR, which will be converted into the future capital. So because CRR is available only for the purpose of issue of fully paid bonus shares only. Fully paid bonus share. It is nothing but what future equity share capital. Okay. So if the buyback is made out of the free reserve, and remember, nominal value of equity shares bought back out of the free reserve is a transferred to CRR. And why it is created? To provide security to the creditor or to maintain the capital as intact. And one more point is CRR will be used only for one purpose, nothing but for issue of fully paid bonus shares only. Okay. So we discussed only one point, nothing but if the buyback is made out of a free reserve. The buyback is made out of what? Free reserve. For example, if the buyback is made out of the proceeds from the fresh issue of the shares, what happened? For example, consider the same scenario, balance sheet, equity share capital 10 lakh, preference share capital 5 lakh, general reserve 5 lakh, and creditors, for example, 10 lakhs, and total 30 lakh, and assets equal to 30 lakh. So, for example, preference shares of rupee 2 lakh issued, and that amount is used for buyback of equity shares of rupees 2 lakh. Then what happened? First, so first reason, what I told you, the first reason, and to maintain a security to the creditor, to provide security to the creditor. So for example, if the buyback is made, if the buyback is made, first we have to issue the preference share. When the preference share is issued, we write the entry what bank account debited to preference share capital. Here 2 lakh is added to assets and the preference share capital 2 lakh. And when we pay the amount to the equity shareholder, then equity shareholder 2 lakh is reduced and assets 2 lakh has been reduced. Is there any change in total assets? No. And there is no change in security to the creditor. And second one is to maintain the capital as an intact. And previously, what is the capital? We have 10 plus 5, 15 lakh. And even after buyback, equity share capital become 8 and preference share capital become what? 7. And what is the total? 15 lakh. And before buyback, we have 15 lakh. After buyback also, we have 15 lakh. There is no change in capital also. So, to maintain the capital as intact, to provide security to the creditor, both are satisfied. That's why if the buyback is made out of the proceeds from fresh issue of shares other than same class of equity shares bought back, remember, no CRR is created. No CRR is created. So CRR is created only if the buyback is made out of free reserves. CRR is created to maintain security to the creditor, and CRR is created to maintain the capital as a intact. If buyback is made out of the proceeds from fresh issue of shares, remember no CRR is created. I hope you understand and got the clarity about why the CRR has been created. Okay, so that is the one and one of the important one. So here. Okay, so if the buyback is made out of the free reserve, then CRR has to be created, and CRR is used only for issue of fully paid up bonus shares. And another one, and these are the 3 points we have to remember, and these 3 points are also used for calculation of maximum permissible number of equity shares bought back. Maximum number of equity share, maximum permissible number of equity shares to be bought back. Generally, there are three tests we have, and one is the share outstanding test, resource test, debt equity ratio test, and just hold it on, and we'll discuss these three tests at later. Okay, and okay, and next one. These are the journal entries. First, we discuss the journal entries, and later, what is the maximum number of shares to be bought back will be discussed. And coming to the journal entries. And so, coming to the journal entry, first remember whether given equity shares are fully paid up or not. If the equity shares are not fully paid up, then we have to make it them as fully paid up. Already I told you how to make it them as a fully paid up. First, demand the final call. Share final call account debited to share capital, and then bank account debited to share final call account. And the second one, verify the sources. Whether buyback is made out of free reserves or fresh issue of share. If the buyback is made out of the fresh issue of share, then for issue of shares, we have to write the entry. Bank account debited to share capital if the shares are issued at par, or bank account debited to share capital to security premium if the shares are issued at premium. And third one is if the buyback is made out of the free reserve. Generally, free reserve is available in the form of what assets? Either surplus cash we have, or any one of the asset has to be sold and realize the amount, and that amount will be used for doing the buyback. If the surplus cash is there, then no need to write the additional entry if no asset has been sold and the details not given in the problem. If any asset has been sold, we have to write the entry for that one. And generally, we have one point sale of investment. If the investment is sold for profit, then we write the entry what? Bank account debited to investment to profit on sale of investment. This profit on sale of investment generally transferred to what? Profit and loss account. So simply we write the entry bank account debited to investment account to profit and loss account. And if the investment sold for loss, then we write the entry what? Bank account debited loss on sale of investment to investment account. And the loss on sale of investment we transfer to profit and loss account. So we can write the entry bank account debited, profit and loss account debited to investment. And so that is the second one. And third one is what is the due entry? Due entry means how the buyback is made. Whether buyback is made at par or premium or at discount. If the buyback is made at par, remember only one amount is payable to the equity shareholder, nothing but what? Par value. In that case, equity share capital we transfer to the shareholders. We write the entry equity share capital account debited to equity shareholders or shares bought back. You may write anything. And generally in institute book they followed equity shares bought back. That's why we followed that one. So equity share capital account debited to equity shares bought back account or equity shareholders account. For example, if the equity shares are bought back at premium, then remember two amounts we required to pay to the shareholder. One is par value, another one is premium on buyback, and both we transferred to shares bought back. So we write the entry equity share capital par value, premium on buyback to equity shares bought back or to equity shareholder. Sometimes practically this is impossible. Generally, we have buyback is made at premium. So theoretically we have it. If the buyback is made at discount, then we write the entry equity share capital account debited to shares bought back to capital reserve. To capital reserve. And if the amount is paid, then we write the entry shares bought back account debited to bank. And for writing off of the premium, and remember the premium on buyback can be written off by using either free reserves or security premium. Either free reserves or security premium. So we can write the entry what? Security premium account debited or free reserves account debited to premium on buyback. Generally, we made first out of security premium and then profit and loss account and then to general reserve. So security premium account debited, profit and loss account debited, general reserve account debited to premium on buyback. Okay. And the last one, if the buyback is made out of the free reserves, and remember the nominal value of equity shares bought back is transferred to CRR, nothing but general reserve account debited, profit and loss account debited to CRR. And the question is, sir, security premium is a free reserve for the purpose of section 68, nothing but for the purpose of buyback. Then the question is, shall we use the security premium to transfer the amount to CRR? To transfer the amount to CRR. So remember, security premium is used to write off the premium on buyback. To write off premium on buyback. But security premium cannot be used to transfer to CRR. So no amount we transferred from security premium to CRR. Remember. So security premium can be used to write off the premium buyback, but not used to transfer the amount to CRR. And the amount transferred to CRR should be made out of free reserves only. And sir, you already told throughout the Section 68 of Companies Act 2013, security premium is treated as a part of free reserve, correct? Yes, already I told you, security premium is treated as a part of the free reserve for the purpose of Section 68. But CRR is created as per Section 69. CRR is created as per Section 69 of Companies Act 2013. Only free reserves are used to transfer to CRR. What is the free reserves? General reserve and profit and loss account. Security premium not be used to transfer to CRR. Okay. So these are the journal entry. What are the entries? First, so if the equity shares are not fully paid up, first make it them as fully paid up. First demand the final call, share final call account debited to share capital, bank account debited to share final call. And second one, so if the sources, so if the buyback is made out of free reserve, then write the entry for sale of investment. Investment sold for profit. Then bank account debited to investment to profit and loss account. If the investment sold for loss, bank account debited, profit and loss account debited to investment. And if the buyback is made out of proceeds from fresh issue of shares, then bank account debited to equity share capital or bank account debited to preference share capital or bank account debited to share capital to security premium. And then what is the due entry? If the buyback is made at premium, two amounts we require to transfer to equity shareholder. One is equity share capital, another one is premium on buyback. Equity share capital account debited, premium on buyback account debited to equity shareholders or equity shares bought back. And if the buyback is made at par, only one amount is liable to pay. Equity share capital account debited to equity shareholders or shares bought back. And when the amount is paid, shares bought back account debited to bank. And then for writing off of the premium on buyback, two amounts we have. One is free reserve, security premium. We write the entry, security premium account debited, profit and loss account debited, general reserve account debited, to premium on buyback. And for creating the CRR. CRR is created only when if the buyback is made out of free reserves. So general reserve account debited, profit and loss account debited to CRR. Security premium not used to transfer to CRR. Okay, I hope you understood. Then, so first we'll see some problems. So here, first for example, M Limited furnished the following balance sheet on 31st March 2000 X1. Okay, and here is the balance sheet data we have, and share capital is provided. And in the equity share capital, in the equity share capital, in the equity share capital, all equity shares are fully paid up. All equity shares are already given as what? Fully paid up. Okay. Then here, company wants to a company passed a resolution to buy back 20% of its equity share capital, and the buyback price is 15 rupee per share. So, and for the purpose, investment has been sold for 13 lakh. Investment of 30 lakh for 25 lakhs, and there is a loss of rupees what? 5 lakhs. So then for this, what is the entry they recorded? Bank account debited and profit and loss account debited to investment. Bank account debited is how much? 25 lakh. Profit and loss 5 lakh, and investment is how much amount? 30 lakh. And so in second entry, and we need to write the entry for due entry. Here in by equity shares bought back at 15 rupee. Actually 10 rupees is the face value. We are buying back at 15 rupee. 5 rupees what? Premium. Then what is the journal entry here? So we have to transfer two amounts to shareholder. And one is equity share capital account debited, and another one is premium on buyback to shares bought back account. Shares bought back. And equity share capital, we are purchasing 20% of equity shares. And how many equity shares we have? 20,000. 20,000 into 20%. Nothing but how many shares? 4,000. 4? Sorry. This is the preference shares. And we have to see what equity shares. And 3 lakh equity shares we have. And 3 lakh into 20%. Nothing but what? 60,000. And 60,000 into 10 rupee. 6 lakh is equity share capital. 5 rupee. 3 lakh is the premium on buyback. And the total amount due is 9 lakhs. So, what is the entry we recorded? Equity share capital 6 lakh, premium on buyback 3 lakh, and shares bought back 9 lakh. Then, when the amount paid, shares bought back, account debited to bank account. How much amount? 9 lakhs. 9 lakh. Only so few entries we recorded. First entry, first whether equity shares are fully paid up or not. As given equity shares are fully paid up, then ignore it. Then, so what is the source? Free reserves. What is the source? What? Free reserve. So here we sold the investment. Investment sold for loss. Bank account debited, profit and loss account debited to investment. And next. So due entry. What is the due entry? Equity shares bought back at premium. Then equity share capital, premium on buyback account debited to shares bought back. And when the amount paid, shares bought back account debited to bank account. And so two more entries we have to record here for writing of the premium on buyback and to create CRR. To create what? CRR. So premium on buyback is transferred to what? Security premium. Already we have the security premium. What is the premium we have? Around 3 lakhs. Around 3 lakhs. We have security premium of how much amount? 5 lakhs. So security premium account debited to premium on buyback 3 lakhs. And next one for creating the CRR. CRR is created out of free reserve. Free reserves here is nothing but revenue reserve is there. This is the free reserve. And the profit and loss account is the free reserve. Capital reserve is not a free reserve. Even security premium is also free reserve. But remember, security premium not used to transfer to CRR. So first we use the revenue reserve. So revenue reserve account debited to CRR. Total amount is enough here. Already 40 lakh is there. We required only 6 lakh. The nominal value of equity share bought back is only transferred to CRR. So what is the entry? Revenue reserve account debited to CRR. How much amount? 6 lakhs. Okay. This is the one. So journal entries are very easy. Okay. But the problem is not relating to the journal entries. The problem is how to compute the maximum number of shares bought back. Maximum number of shares bought back. And for buying back of the equity share, shall we bought back all equity shares we have at a time? The answer is no. Section 68 clearly stated. So they three points has been inserted, and based on the 3 points, we have to calculate what is the maximum number of shares should be bought back, and that is nothing but least of the following 3 tests. And test 1, share outstanding test, and resource test, net equity ratio test. And test 1, share outstanding test. So the maximum number of shares bought back should be less than or equal to 25% of equity shares outstanding. 25% of equity shares outstanding. So number of equity shares outstanding into 25% we have to consider. So share outstanding test, as per share outstanding test, maximum number of shares bought back is equal to number of equity shares outstanding into 25%. And second one, resource test. What the resource test says? The buyback of equity shares cannot be more than 25% of paid share capital and free reserve. Cannot be more than 25% of paid up share capital, free reserve. What is the paid up share capital? Equity share capital and preference share capital. And free reserves are nothing but general reserve, profit and loss account, security premium, revenue reserve. Because here this section is provided by section 68. For the purpose of section 68, security premium is a free reserve. So equity share capital, preference share capital, we get paid up share capital. General reserve, P and security premium, other free reserve. This is the total equity. Out of that, we need what? 25%. But remember, this is what amount. But here we are calculating number of equity shares bought back. So number of equity shares bought back is equal to 25% of equity by what is the buyback price. 25% of equity by buyback price. Okay. And so this is the resource test. And third one, most important one, debt equity ratio test. And what it says, debt equity ratio after buyback cannot be more than 2 is to 1. Cannot be more than 2 is to 1. So here, if the debt is if the debt is 2, then equity should be half of the debt. Minimum half of the debt should be the equity. So in this case, how to compute the maximum number of shares bought back? So here I provided. So as per debt equity ratio test, first consider what is the debt as per given balance sheet. Here debt means what? Long term debt and short term debt. Long term debt and short term debt both are covered under the debt. And what is the equity to be maintained? Nothing but what? Half of the debt. And first point into 1 by 2. And what is the present equity? Already we calculated what is the equity in a resource test and consider the same directly. So we consider it from test 2. And what is the excess equity we have? Excess equity means present equity minus equity to be maintained. Excess equity. For example, if it becomes 0 or if it become negative, in these two cases, buyback is not allowed. Because if it is 0, there is no excess equity to bought back. If it is a negative, even present equity is not permissible to do the buyback. Only if it is positive, we can do the buyback. Okay. And here, one more important point is nothing but what is the excess equity? Here, excess equity is nothing. What is the maximum equity to be bought back? Maximum equity to be bought back. And amount transferred to CRR. This is what excess equity. Amount required to be transferred to CRR. What is the maximum equity to be bought back? Plus amount required to be transferred to CRR. That is only cover. Because here equity is nothing but what? Equity share capital plus free reserves. Here from the share capital we can do the buyback. What is the maximum amount of equity to be bought back? And from the free reserves, if you are doing the buyback out of the free reserve, then we require to transfer to CRR. That is also forming part of this excess equity only. Okay. And if it is not made out of the free reserve, then second point is not required. Only this excess equity is representing maximum equity to be bought back. Okay. So what is the maximum equity to be bought back means what? Number of equity shares bought back into buyback price. Number of equity shares bought back into buyback price plus amount transferred to CRR is equal to number of equity shares bought back into face value. So which amount we transfer to CRR? The nominal value of equity shares bought back out of the free reserve is only transferred to CRR. Okay, into face value. So here number of equity shares bought back is common. So into buyback price plus face value is equal to excess equity. Equal to what? Excess equity. So number of equity shares bought back is equal to what? Excess equity by buyback price plus face value. Excess equity by buyback price plus face value. If the buyback is made out of proceeds from fresh issue of share, then this face value is not required. Only buyback price is enough. because no need to transfer to what CRR. Okay, so I hope you understand the debt equity ratio test, and the majority of the student feel some difficulty in this test. And share outstanding test, resource test is very easy. Debt equity ratio test is only the difficult part. So first we have to consider debt as per balance sheet. Remember, long term debt and short term debt both are considered. We have to consider debt. If any trade payable we have in current liability, don't consider it. Only long term debt and short term debt we have to consider. Trade payable, bills payable are not considered as a debt. And equity to be maintained, half of the debt. Present equity, we take it from resource test. And excess equity, present equity minus equity to be maintained. And maximum, so excess equity is representing 2.2 amount. One is the maximum equity to be bought back plus amount transferred to CRR, that is the excess equity. Number of equity shares bought back into buyback price plus number of equity shares bought back into face value. If you solve it, number of equity shares bought back is equal to what? So excess equity by buyback price plus face value. So these are the three tests we have, and one is what? Resource test, sorry, share outstanding test. Second one is resource test, and third one is what? Debt equity ratio test. And among these three tests, and the least number is treated as maximum number of equity shares bought back. Maximum number of equity shares bought back, and this is very important. And majority of the students did a mistake in this point. Okay. So this is the one. Okay. And next, we'll do the problems. And coming to problem number 3. And Perotta Limited, a non-listed company, has the following capital structure: equity, share capital, some reserves and surplus provided. In the reserves, general reserve is the free reserve. Security premium is also free reserve for the purpose of section 68. Profit and loss account is also a free reserve. And infrastructure development reserve, if nothing was stated, it is not a free reserve. And loan fund, this is nothing but what? Debt. And the shareholders of Parrot Limited, on the recommendation of their board of directors, have approved 12th September a proposal to buy back the maximum permissible number of equity shares. Consider the large surplus funds available at the disposal of company. The prevailing market value of the share is 25. And in order to induce the existing shareholder to offer the shares for buyback, it decided to offer the price 20% over the market. And then nothing but buyback price is equal to 25 plus 20%. 1 minute. Nothing but what? 5. And the 25 plus 5, 30 rupee. 30 rupee per share is the offer price of buyback. And you also informed that infrastructure development reserve is created to satisfy the Income Tax Act. Nothing but that is the specific reserve, not the free reserve. Not the free reserve. Okay. And you are required to compute the maximum number of shares that can be bought back in the light of the above information, and also under the situation where the loan funds are 1200, 1500. And remember, there are three tests we have. So for calculation of maximum number of shares to be bought back, so share outstanding test and the resource test, in the two tests debt is not involved anywhere. So debt is considered only in case of debt equity ratio test. So there is a change in debt that is having the impact only in test 3, nothing but debt equity ratio test. And first two tests are same for any type of debt, any amount of debt. Okay. And here already in the problem we have one class of one amount of debt, 1800 crore, and two more situations we provided. Under these three situations we have to calculate. Okay. So so first first one, shares outstanding test. What is the number of shares outstanding on the balance sheet date? How many shares we have? So here 10 rupee shares fully paid up, 330 crore. So here 3 means 33 crore. 330 by 10, 33 crore. So 33 crore into 25%. So 33 crore into 25%. Nothing but 8.25 crore. That is the first one. And resource test. In case of resource test, first share capital we have to consider. So what is the share capital? 330 crore. And what is the free reserves? Free reserves are nothing but what? General reserve. What is the general reserve? 240 crore. And profit and loss account 90 crore. Security premium 90 crore. Okay. Security premium 90 crore. So here 240 plus 90 plus 90. How much? 420. And total 750. This is what equity. But out of that, we have to consider 25% of equity. So 750 into 25%, nothing but 187.5 crore. And what is the buyback price? Already we calculated it as 30. So 187.5 by 30, nothing but 6.25 crore. So number of equity shares bought back 6.25 crore shares. This is the resource test. And these two are common for any amount of debt. And only that there is a change what debt equity ratio. And third one, debt equity ratio test. And what is the first one? First debt. Case 1, 1800 crore. And case 2, 1200 crore. And case 3, 1500 crore. So this is the debt we have. And equity to be maintained. Half of the debt means 900, 600, 750. And what is the present equity? So present equity, we have to take it from the step 2. So test 2, nothing but what? So 750 crore. Already we computed, right? So 750, 750. And then we compute what is the excess equity. Excess equity means present equity minus equity to be maintained. Here, there is a negative figure 150 and here 150 positive, this is 0. So, in these two cases, buyback is not permissible. So, buyback is not allowed. Has it become negative? Here, buyback is not allowed. Has it become 0? Buyback is allowed only when the excess equity become positive. Okay, excess equity become positive. Then, so here, in case of here, what is the excess equity? Maximum equity to be bought back plus amount transferred to CRR. That is what excess equity. And here, how can we write? Number of equity shares bought back into buyback price plus face value 150. Then number of equity shares bought back here. Number of equity shares bought back here. 150 by 30 buyback price, face value 10. So 150 by 40 equal 3.75. So in the first two cases, no buyback is allowed. So sorry, 1800 crore, 1500 crore case, no buyback is allowed. Buyback is allowed only in case of 1200 crore. Okay. Then simply write the summary. So 1800, 1200, 1500. Shares outstanding test, resource test, debt equity ratio test. Shares outstanding test is how much? 8.25, 8.25, 6.25, right? So 8.25 for any case. Here 6.25. Here 0 in two cases. Here how much? 3.75. So what is the maximum number of shares bought back? Here not allowed. Here also not allowed. Only 3.75 crore. And the entry should be recorded only for 1200 crore type of debt, 3.75 crore shares. 3.75. What are the entries we recorded? So first we write the due entry. So first, sorry, no investment has been sold. Directly we write the due entry. Equity share capital account debited. Premium on buyback. Here, equity share capital 10 rupee per share, but we are doing it 30. 20 rupee premium is there. So equity share capital account debited. Premium on buyback to shares bought back. And after that, while making the payment, shares bought back account debited to bank. And for writing off of the premium, security premium account debited to premium on buyback. And for transferring to CRR, so general reserve account debited, profit and loss account debited to CRR. That four entries we have to record. So for example, in these three cases, we have the maximum number of shares bought back permissible. Three cases. Then we have to write the entries for three cases. Yeah, we have to write the entries for three cases. Okay. And this is one of the important problem. Next. And problem number four, similar problem. Okay, just leave it. So problem number five also, but one more problem is there, and which is the combination of buyback and a redemption of preference shares, bonus shares, and a redemption of debentures and ESOPs. Okay, so here this is the problem. Problem number two. So extra limited, a non-listed company furnishes you with the following balance sheet as on that. So here is the balance sheet, and here all equity shares are fully paid and all preference shares are also fully paid. So here capital reserve is not a free reserve. Revenue reserve is free. Remember, revenue reserve is a different from revaluation reserve. Revaluation reserve is not a free reserve. That is specific reserve as per section, as per AS 10 PPE. So security premium is a free reserve only for the purpose of buyback. Only for the purpose of buyback. But for redemption of preference share, security premium is not a free reserve. Remember that point. Reduction of preference share, security premium is not a free reserve. And long-term borrowings we have. And company redeem the preference shares. Company redeem the preference shares. In case of preference shares. So, and here we have the theory. In case of preference shares redemption. And in case of preference shares redemption, just similar to the buyback. Similar to the buyback. So preference shares redeemed out of the free reserves and proceeds from fresh issue of share. But for the purpose of redemption of preference share, free reserves does not include security premium. Only revenue, general reserve, revenue reserve, profit and loss account is covered. Okay. And only fully paid up preference shares can be bought back. And if the preference shares are redeemed out of the free reserve, the nominal value of preference shares redeemed is transferred to CRR. If any preference shares redeemed out of the proceeds from fresh issue of shares, then so no need to transfer to CRR. And premium on redemption of preferences can be written off by transfer to either security premium or profit and loss account or free reserve. It means every entry is every point is common. Only few points like security premium. Security premium is a free reserve in case of buyback, but not the free reserve in case of redemption of preferential. For redemption of preference share. If the preference shares redeemed at par, then preference share capital account debited to preference shareholder. When the preference shares redeemed at premium, preference share capital, premium or redemption of preference shares to preference shareholders account. When the amount paid, preference shareholders account debited to bank. And for creating CRR, general reserve, profit and loss to CRR. For writing off of the premium, security premium, profit and loss account debited, so to premium or redemption of preference share. And remember, security premium can be used to write off the premium on redemption of preference share as per section 52 of Companies Act 2013. So as per that we follow. Okay. So based on this, the first one, the company redeemed preference shares at premium of 10 rupee, at premium of 10%. What is the preference shares? So we have 20 lakhs, sorry, 20 lakhs, 20 lakhs. So 20 lakhs plus 10% premium, 22 lakhs. And what is the entries to be recorded? First, 9% redeemable preference share capital account debited 20 lakhs, premium or redemption of preference shares 2 lakhs, 2 preference shareholder 22 lakhs. And for payment, preference shareholders account debited to bank. And security premium account debited to premium on redemption of preference share or profit and loss account debited to premium redemption of preference share. And For creating the CRR, we have to write the entry. If the CRR is how much amount required to create? 20 lakh here. Here, CRR is how much? 20 lakhs. Okay. And second one is for buyback. So here 3 lakh equity shares bought back of 10 each at 30 and 20 rupees the premium. And the payment for the above made out of the huge bank balance. Huge bank balance means what? Out of the free reserves. And same way, for doing the buyback, what are the entries? Here equity shares bought back at premium. So we write the entry equity share capital account debited 10 rupee. So premium on buyback account debited. So 20, two shares bought back 30. And when we make the payment, equity shares bought back account debited to bank 30. And premium on buyback is transferred to security premium or revenue reserve. Security premium account debited to premium on buyback or revenue reserve account debited to premium on buyback. And for creating this year, here how much amount is created? 3 lakh into 30. Correct? So 3 lakh into 10. Sorry, 3 lakh into 10. How much amount? 30 lakhs. CRR is required to be created is how much? 30 lakh. So total how much amount CRR is required to create? 50 lakh here. So CRR is created out of revenue reserve. So sufficient amount is there. So CRR account, so revenue reserve account debited to CRR 50 lakhs. Okay. And next, third one, included its inter investment were investment in owned debentures costing 2 lakh, face value 2.2 lakhs. The debentures were cancelled on 1st April 2000 X1. So generally, here in case of redemption, if it is made out of purchase of own debenture, then investment and debentures we have. Debentures are on liability side, investment in own debentures are on asset side. And debentures are always shown at face value, 2.2 lakh. And investment in own debentures are shown at cost price, nothing but what 2 lakh. And these both are cancelled. So debentures having the credit balance. So for cancellation, we have to debit it. Investment is having the debit balance. For cancel, we have to credit it. So debentures account debited 2.2. To investment in own debentures 2 lakhs. To the remaining amount we transfer to capital reserve 0.2. 20,000. Okay. If any cancellation of the debentures while cancelling the debentures with the investment in own debenture, any profit we have transferred to capital reserve, loss we have transferred to profit and loss account. So debentures account debited 2 lakh 20,000, to investment account 2 lakh, to capital reserve 20,000. Okay. And here, and the last one, company had 1 lakh equity stock options outstanding on the above mentioned date to the employees at 20 rupee when the market price was 30. This was included under current liabilities. And on 1/4/2000 X1, employee exercised their option for 50,000. And we have to write the entries for number of shares or exercised. And here, generally, ESOPs are issued to the employees for encouraging the employees to retain them without leaving the organization. And actual 30 rupee market price, we provided at 20 rupee. How much amount of loss is there to the company? 10 rupee. What is the loss to the company? 10. And the employee paid only 20 rupee to the company. We offered shares to the employee at 20 rupee per share. How many shares they purchased? 50,000. So bank account, we received amount from the employee 20 rupee per share, 50,000 into 20, 50,000 into 20. But actual market price of the equity share is 30 rupee. So we offered it at 20 rupee. The remaining 10 rupee won by the company itself. The remaining 10 rupee won by the company itself. And that we adjusted it to the employee stock option outstanding account. So, but here that was included in the current liability. They stated it as included in current liability. Actually, what is the entry to be recorded? Actually, what is the entry to be recorded? So, bank account debited. So, exercise price we have to write. And employee stock option outstanding account debited. So here market price minus exercise price we have to write difference. That loss what required to borne by the company. To equity share capital face value to security premium, the remaining amount. And this is the entry to be recorded. Here, bank account here is nothing but 50,000 into 20. Employee stock option outstanding in the given case, it is already available in current liability. Current liability. That's why instead of employee stock option outstanding, mention what current liability. Mention what current liability. So 50,000 into 10. 50,000 into 10. And next, employee share capital 50,000 into 10, and the remaining amount total 30, 50,000 into 20 transfer to security premium. And what is the entry to be recorded here? Bank account debited, current liabilities account debited, to equity share capital, to security premium. That is the entry to be recorded for this one. So for redemption of the preference shares, we wrote the entry for buyback and for cancellation of investment in own debenture and for ESOPs. And we have to write, and balance sheet I didn't discuss here, and just follow the schedules. Okay. And these are the entries we have to record here. This is important question. And we have redemption of preference shares and buyback and invest cancellation of the investment and ESOPs related. Sometimes you may have the point from bonus shares also. You may have the point from bonus shares. In case of bonus shares generally issued by the company at free of cost, and we also call as capitalization of the profit. First, for capitalization of the profits means utilization of the free reserves. For utilization of the free reserves, we write the entry. What are the which resources we can use? For CRR, we can use security premium. We can use capital reserve realized in cash can be used, and general reserve or revenue reserve and profit and loss account. This is the order we have to follow. So CRR account debited, security premium, and capital reserve if any, general reserve, profit and loss to bonus to shareholder. For issue of bonus shares, bonus to shareholders account debited to equity share capital account. This is simple, and already you have this point in foundation. Okay. So this is relating to what? Buyback. I hope you understand, and I hope you understand, and each and every concept I discussed here, and so please go through the entire video. So please follow it. If you have any doubt, and please comment below the video, or you may connect me through the telegram channel, and the link is provided in the description box. Okay. And please do the practice of the problems, and hardly 2 3 models we have. First, journal entries, and another one, maximum number of shares to be bought back, that is the one. And one more important point, and please give a comment below the video which lecture you want in the further sessions. Okay, based on that I will plan it. Okay. Okay, bye bye, take care.